In episode 1, The End of the Dollar Era, we uncovered the cracks in the old financial order, how debt, inflation, geopolitical fractures, and reserve shifts signaled that the world had begun the Great Monetary Reset. Today, in episode 2, The Emerging Multipolar World, we go deeper, because where episode 1 showed why the old system is breaking, episode 2 reveals what's replacing it. A world no longer powered by one currency, one economy, or one super engine, but by many. For almost 2 decades, China was the world's growth engine, powering the commodity supercycle, the Asian manufacturing rise, and the fastest poverty reduction in history. But that era is behind us. China's long-term growth path shows the shift clearly. The real GDP declined from 14% in 2007 to 10% in 2010 to 4% in 2025 and 3% projection for 2029 is showing a clear structural slowdown, driven by an aging population, falling productivity, a broken real estate sector, and record debt. China still matters, but the era of the unstoppable engine is over. When a giant built for speed is forced to slow down, the world feels the drag. Now look at the United States, the world's consumption engine. Yes, spending has grown, but most of that growth comes from essentials: food, fuel, and clothing. Durable goods, cars, appliances, electronics had a COVID stimulus spike, but then flattened. The US economy is 70 to 80% consumption, and that consumption relies on low rates, cheap and easy credit, heavy credit card use, and massive federal deficits. The stress is now visible. Credit card delinquencies are rising, auto and personal loans rising faster, mortgages are stable only because owners gained equity. The American consumer is still spending, but increasingly by borrowing from tomorrow. An economy can borrow its way through a moment, but not through a decade. And here's the deeper shift. This model works when the world depends on the US consumer, but today, global demand is spreading across India, ASEAN, the Middle East, and Africa. When the world stops orbiting one customer, a debt-driven model becomes fragile. So finally, China has downshifted, the US consumer is overstretched. When the old engines slow, something else has to rise, and that is where the story of the new world begins. When one engine fades, another starts, and this time it's not one, it's many. For the first time in decades, Asia's fastest growing region is not China. It is India and Southeast Asia. Here's what the IMF's real GDP data says. India consistently growing at around 6.5% for the next 4 to 5 years. Vietnam close to 6%. Indonesia at 5%, while Malaysia stays steady at 4%. These aren't spikes, they are structural growth powered by young demographics and rising incomes. But the real shift is in global demand. According to the World Bank, Asia's share of global commodity consumption is rising. India is now the main engine of global demand growth. For 20 years, China dominated global consumption, but after 2020, demand became distributed because of India's infrastructure boom, Vietnam's electronics surge, Indonesia's metal and EV supply chain, Malaysia and Thailand's manufacturing hubs, the Philippines' rising services economy. Together, India and ASEAN form the world's largest population bloc, the fastest rising consumption bloc, the biggest middle-class expansion for decades, the number one destination for global manufacturing relocation. This corridor, from Delhi to Hanoi to Jakarta, is the new Eastern growth pole. Oil has a way of exposing who truly runs the world. Look at global oil prices across Brent, WTI, Dubai, and APSP. 3 eras emerge. First era led by China boom between 2002 and 2012. Oil prices surged from $20 to $110. China drove everything. The second era, from 2013 to 2019, led by China's slowdown and US shale. Prices collapsed, shale flooded the market, a bipolar world emerged. And the third era came after 2020. Oil jumped from $40 to $100, but with no China boom. For the first time, the spike was driven by distributed global demand. Demand is now multipolar. World Bank data shows China's share of new demand fell to 24%. India contributes 25%, ASEAN nearly 30%, while advanced economies shrank demand. The world's marginal barrel now comes from many Asian countries, not one superpower. Supply is also multipolar. OPEC Plus controls marginal supply. Russia has redirected exports to the east. US shale hit a structural plateau. Underinvestment tightens global production. In the 2000s, China moved prices. In the 2010s, US shale moved prices. In the 2020s, no single nation moves energy anymore. Demand is multipolar, supply is multipolar, pricing power is multipolar. Energy is only the beginning. The same pattern appears in every commodity market. IMF and World Bank commodity indices show three eras. Era 1, China supercycle, 2002 to 2012. All categories surged together. Era 2, China slowdown, 2013 to 2019. Stagnation everywhere. Era 3, post-2020 spike. Every commodity category spikes at once. This can only happen when demand comes from multiple regions. India infrastructure, ASEAN manufacturing, Middle East investment, Africa's consumption rise, US reshoring, Russia disruptions, China reopening. When all commodities rise together, the world is no longer unipolar. But commodities weren't the only markets to break their rhythm. Something far more surprising happened next. Housing, the heartbeat of every economy, began telling a very different story. For 20 years, the housing cycles acted like they were wired together. Before 2000, each country moved on its own. But from the year 2000 to 2020, the world snapped into sync. Not because the economies were the same, but because every central bank copied the Federal Reserve. Same cuts, same hikes, same playbook. Global finance had one conductor. And then, after 2020, the orchestra fell apart. China enters a deep housing winter. India barely moves. Australia crashes and surges back. Canada drops sharply. New Zealand plunges. Eurozone freezes. US stays flat at record high levels. 7 countries, 7 different outcomes from the same global shock. For the first time in decades, the world is no longer dancing to one interest rate drum. Credit cycles that once moved together are now diverging into regional paths. The world no longer shares one monetary heartbeat. It now beats with multiple financial pulses. Faster in some regions, slower in others, but no longer in sync. This isn't just desynchronization, it's financial independence emerging in real time. And beneath all of this lies the most powerful force of all, liquidity. Across the world, the response to slowing growth and rising debt is the same: print more money. Today, the US is preparing $2,000 stimulus checks. Japan is preparing a $100 billion stimulus package. China has approved a $1.4 trillion stimulus package. The Fed is officially ending QT in December. The US is issuing $1.9 trillion in treasuries per year. Canada is restarting its quantitative easing program. Global M2 money supply is at a record $137 trillion. Global rate cuts are at 320 plus over the last 24 months. This is not coordination, this is systemic fatigue. When every major economy prints at once, the world doesn't enter a strong dollar system. It enters a weak fiat world. And in a weak fiat world, real assets raise. Commodities, energy, gold, strategic metals, regional trade networks. When money becomes the solution to every problem, money itself becomes the problem. Liquidity doesn't just support economies, it rearranges power. Here's the new map of global economic gravity. United States is the financial pole, China the industrial pole, India ASEAN becomes the growth pole, Middle East energy pole, and Africa demographic and resource pole. This is not geopolitics, this is the new economic order forming in real time. For decades, the world depended on one engine. When it slowed, the world slowed. But the data reveals a new reality. Growth now has multiple centers, commodity cycles reflect distributed demand, energy pricing is set by a coalition, housing cycles have decoupled, credit cycles move regionally, a liquidity wave is accelerating the shift. The world is redistributing its economic gravity, and when gravity redistributes, power redistributes. This is the birth of the multipolar world. This is episode 2, the emerging multipolar world. And in episode 3 of the Great Monetary Reset, we explore the next question. How will commodities, currencies, and capital flows reorganize in a world with many centers of power? The new commodity order, episode 3, is coming soon.